Hey everyone, welcome to the KE Report in a daily editorial on this Tuesday, May 6th, chatting with Dave Erfle, founder and editor of the Junior Miner Junky, focusing on the precious metals sector. And it's another good day for precious metals, especially gold, as gold is up almost $100 right now, trading. Actually, it is just up $100, trading a little over $3,400. And silver's having a pretty good day too, up almost a dollar over $33 again. Silver still remains pretty much range bound in this higher range, and gold, man, oh man, it's pushing right back close to those all-time highs after that really explosive move in the middle part of April and a very short correction to end that month. Dave, there are a couple big drivers, I guess, behind this gold move. One that we'll start talking about here is gold demand. Now seems to be driven out of Asia. A lot of news stories out there talking about just how much the Chinese are driving the gold price and India driving the gold price in terms of simple demand side. Dave, what have you been seeing out there, and how important is it to understand that while the Western investor, the US, is on board for this gold rally just by what we've seen in the ETF inflows, Asia now kicking back into high gear?
Yeah, really interesting. Last week we had, that huge downdraft in the gold price, right? Gold corrected $300 pretty quickly, which was pretty much expected. We had an isolated top at 3,500, and it was a lot of it was blamed on the Chinese demand drying up because of the Labor Day holiday, right? They had a holiday begin, I think it was Thursday or Friday, and so China was closed. China market closes, gold corrects sharply, and that holiday continued through Monday. So China didn't open up until Tuesday, today. But yesterday, everybody was expecting, myself included, the gold price to correct some more, especially heading into the Federal Reserve FOMC meeting on Wednesday, which started today. But the gold price went up over $100 yesterday with China still closed. And yet analysts were still attributing it to Asian demand, but that couldn't be the case. But I think it was geopolitical concerns because of what's happening in Ukraine, the Middle East, and now Sudan, and now between Pakistan and India and China and the Taiwan situation that's still simmering. But all these geopolitical concerns fears are ramping up overseas, and the Fed seems to not really matter much anymore because basically Jerome Powell's already come out and said we're already in a stagflationary environment. We got lower growth, and we've got sticky inflation. We've got a Q1 GDP of less than 2, and we've got inflation, well above their fantasy 2% target. So if you take a look at what's happening geopolitically, you take a look at what's happening in Asia. I mean, as soon as they opened up today for business overseas in Shanghai, Chinese buyers returned immediately. And also, Bloomberg just reported that the Shanghai Gold Exchange, they're planning to boost their warehouse network in Hong Kong, and that's operated by the Bank of China. And volume has spiked at the highest volumes in Shanghai gold market history right now.
Dave, when you think about all these factors coming together, especially not just the Asian buying, because there's always been strong Asian buying, but it's stronger than usual right now. I was looking at some charts just yesterday that showing just how huge the inflows are into Chinese gold-backed ETFs. What you just mentioned about the move for China to set up overseas warehouses for the Shanghai Gold Exchange. Obviously, the price of gold historically has been set in London and New York. It seems to definitely be moving the epicenter over to the east, but that's been underway for a while. The relentless central bank demand has been underway for the last couple of years. Is there something bigger going on under the surface of the monetary system, under the surface of currencies, under the surface that this is a more longer term trajectory that gold is on as a financial instrument than maybe people in the West even realize?
Oh, absolutely. I mean, if you take a look at what's going on with the bond market, I mean, bond yields continue to rise, and the US dollar can't get above the 100 level. That is a key psychological support level, and it's now become resistance. And if you take a look at the debt situation, the untenable debt situation, the Fed is pretty much it's out of their control. They can't control what the US spends. I mean, Powell came out on 60 Minutes late last year and said, "Look, this situation's unsustainable." And although the Trump administration has recognized it, there's really nothing they can do about it. I mean, these cuts that Doge is doing is really nothing. The major cuts that they have to do has to go through Congress, and good luck getting those things passed. So the situation is basically that the U.S. continues to have to issue new debt to pay off old debt, and the world understands that, hey, when that treasury window, when countries stop lining up at that treasury window to buy the US debt, that's when the whole system collapses. So I think it's a loss of faith in government, loss of faith in currencies, especially, which has been the major driver for the gold price. And then you got the kicker of the geopolitical situations that I mentioned earlier, all happening at the same time overseas. I mean, this perfect storm for gold continues, even though myself included, are expecting the gold price to have some sort of longer term healthy consolidation. But these consolidations, they last shorter and shorter. So recently, the gold price went up to 3,500. It corrected down to 3,200. That's an 8.5% correction, right? The last time we had a correction that lasted that deep was when Trump was announced as the victor of the election. It took 3 months for that consolidation to take place. Now, this recent consolidation of an 8.5%, it's only taken just a few days. So these consolidations, after these sharp moves down, they're lasting shorter and shorter because there's willing buyers that want to come in and they want to get into the gold market.
Well, and the fact of the matter is, we're seeing funds, banks, all these big name
Right.
institutions raising their forecasts for gold and getting on board with this rally. So it's not just the diehard gold bugs that are paying attention to this market right now. And I think that has been happening for a lot of this year. One other thing that kind of goes along that whole narrative of this shift in the financial system or makeup of the financial system, which again, this has just kind of happened over the last maybe few months in terms of market moves. So who knows how long this is going to last? But the market is also telling us that, as you said, the US dollar, that's not doing anything. Interest rates in the US, the 10-year, that is also stuck. US markets have been correcting while international markets have also been outperforming the US markets. And gold, even the gold stocks, they've been almost the inverse correlated to what the US markets have gone. So it's really not just us saying that people are shifting away from the US. The markets are telling us the same thing. So, Dave, outside of the US dollar, what else really matters to you here when we simply look at the markets and understand what money flows are telling us?
Well, the big thing that stands out to me is the gold sector has finally disconnected from the stock market. So the stock market had that recent dead cat bounce, right? Where it couldn't even get back up to back test its 200-day moving average before it's now started to roll over again. So that's when the gold sector was correcting. So each time the stock market is down now, gold is up and vice versa. And that's what we needed to see, right? I mean, that's what I was harping on, and myself and several others included in this sector were saying that, hey, we need to get investors to stop concentrating on the AI and crypto that continues to go up. So the safe haven gold needs to step up here, and gold stocks especially. So they need to start rotating into gold stocks, and now we're starting to see that. So we're starting to see a major decoupling, and that's huge. And it really started to take notice in the gold stocks, and especially the juniors, when we had that false move down recently, and we had that huge 20% spike in one day in GDX and GDXJ. That's a huge spike pole now that it's got a flag on it. So basically, what you're seeing is this consolidation right above there. I mean, we had 43 in GDX, which was strong resistance going back to 2020, and even going back even farther than that, back when it was support during 2011, 2012, when we started that bear market in gold and gold stocks. And in the GDXJ, I think it was the 57, 58 level. I'd have to go back and check here as far as the GDXJ is concerned. That was around the 54 level now is major support. And then once it broke 61, which was the 2020 high, that's when GDXJ started to take off. And now it's showing relative strength. And you're also seeing a lot of these juniors, separate juniors, bifurcating from the market and really taking off, and they're holding their gains or even moving up while the gold price has been consolidating here. So what you're seeing now, you're seeing internal sector rotation. What I mean is by internal is you're seeing that resource speculators who got in early to gold stocks and have these massive gains in their miners and in their royalty companies, they're rotating some of those profits down now into the juniors as they're starting to outperform the miners.
Dave, one other idea I just want to float by it is in addition to gold and the gold equities starting to outperform the US equities, which is what we've been looking for a long time, I don't hear very many people talking about the shift in capital out of bonds and into gold. And I feel like that's even more germane because people have turned historically to bonds as a safe haven. Clearly, in the recent turmoil of this year, but even on a longer term basis over the last couple of years, bonds have been getting sold as rates have been going higher and higher. If you look at where rates were in 2020 at the very bottom, when we had 0.4% interest rates, and now they're up in the fours, there's been a big sea change in selling of bonds and a lot of capital flowing into gold. Couldn't that be another force that doesn't get as much airtime, but that for conservative investors, they're shifting from bonds to gold?
Oh, absolutely. I mean, it's obvious now that gold has become the safe haven of choice, right? It was competing with Bitcoin for a while. It's definitely been competing with bonds, but now it's become the safe haven of choice. And it's one of the few assets large enough to absorb the hundreds of billions of inflows if and when China and Japan sell US treasuries more aggressively. Because China used to be the biggest buyer of our debt. Now they're the biggest seller. And now Japan is the second largest seller. So that's what it goes back to what I was saying before. When these countries stop lining up at the treasury window to stop buying these bonds, that's when it really gets dicey and gold shines as the only safe haven of choice.
Oh, and that's what we are seeing right now, right? And this has been the narrative for well over just a couple months where we have seen the shift away from US equities, US dollar, really US markets broadly. Now, again, this big picture question of will this last? Are we seeing a true generational shift in markets? Only time will tell, but at least in the last couple months, during this trade war, we have definitely seen a ramp up of these sort of fears and that money flowing into gold. Dave, just looking ahead to the Fed meeting, I know the Fed doesn't really even matter right now because they're standing pat. I don't even think there's much they can do with the economy and with this incoming data because seems like so much of this is in a way self-inflicted with this ongoing trade war, at least in the short term. What do you think the Fed is going to say? They seem to have been pushing back at the government like a lot of financial institutions. Do you think that we're going to see any shift from what Powell has said just recently?
Well, I think it might be a good opportunity for gold profit taking to take place. And to tell you the truth, I'd kind of like to see it because if we see this consolidation here, that it is happening so high and at such overbought levels, it could turn into a blow off top where we have a longer term correction in the gold price. And that may hit the miners even that might may hit the miners more than I would expect. But I really don't see it because I see the Fed basically coming out and they're probably going to be a bit hawkish here. That would be my guess because they don't want to appear to be kowtowing to Trump at all. So I wouldn't be surprised to see this as an excuse for some profit taking in gold, especially, we've seen the gold price go up $200 in the last 2 days. It's back over $3,400 June gold futures. So I think it's going to be a consolidation triangle between 3,500 and 3,200, maybe even 3,000 in the next month or so before we see another spike up. But I think a lot of that depends on what happens overseas too. I mean, if these situations become really, really dicey as far as geopolitically overseas in Ukraine, Iran, and India, Pakistan, and Sudan, and all that, I mean, it's all ramping up. If one of those powder kegs blows, then all bets are off as far as how high the gold price can go.
Well, Dave, let's take this over to the gold stocks. You mentioned the strength in GDX and GDXJ, which are almost all producers of gold, whether it's the seniors or the intermediates and mid tiers. When you think about the margins, we've talked about this ad nauseum, but I think it's worth reiterating one more time. there's a lot of debate online and on Twitter and on different forums about whether the margins are priced into the gold stocks at this point in time. We had a really good Q1 report from a couple of companies. They're still coming in. But when you look at Q2, I mean, goodness gracious, we're halfway through it now, and we've been over 3,000 the whole time. Is it all priced in? Are these gold stocks reflecting the forward-looking markets at Q2, Dave, or is there still more upside in these gold stocks based on where their margins are trending?
I really don't think so. I think there's more upside because, I mean, the overlying principle here is you're seeing mean reversion to the downside in the stock market and mean reversion to the upside in gold stocks. And that's huge. I mean, we've been saying ad nauseum how overvalued the stock market is. I mean, the CAPE ratio is still at 35. And if you take a look at gold stocks in relation not only to the gold price, but in relation to the stock market, they're still ridiculously cheap. And we've yet to see the general investor come into this sector in size. A few weeks ago, when we had the Q1 earnings season kick off, Newmont and Agnico Eagle, they both reported better than expected results. But if you take a look at the sector bellwether, which is Newmont, and the only gold stock in the S&P 500, that only island of safety in the S&P 500, they highlighted 1.2 billion in free cash flow. So given that the company's average realized gold price was around 2,950 an ounce, the second quarter free cash flow could be around 1.5 billion, and that's a total run rate of $6 billion free cash flow per year. I mean, that's huge, and once generalist investors see that, right, they're going to start coming into this sector in size. They're going to start saying, "Look, the stock market is rolling over again. This cash that I have sitting on the sidelines, I don't think I can put it back in the stock market again because it looks like we're going to be in a bear market. So I need to rotate that capital into something that's going up while everything else is going down." I think I mentioned this on your show last week. I mean, this is how I discovered the gold market in the first place back in 2003. You know, I was licking my wounds from losing all this money in the stock market because I got into the dot-com bubble not knowing what I was doing at the end. And it gave me the impetus to say, "Hey, look, if I want to make some money in the stock market, I just got to start doing some proper due diligence." And I came upon the gold sector because it was the only thing that was going up while everything else was going out down, and it literally changed my life. So I think that is going to start to take place here in a big way really soon.
So, Dave, does that mean we should be looking at the PE ratios of these companies? Because there's a wide variety of PE ratios that we're seeing. Barrick is right in the middle of Agnico. Agnico's trailing PE ratios about 48. Newmont is way down there at around 12, 13, and around there. Barrick right around 21. And then you look at the forward PE ratios because of what these guys are expecting, higher earnings coming, those are much lower. So is the opportunity going into, I guess, what we've even said, some of the lower tier miners in terms of their costs rather than chasing something like Agnico Eagle, which does have a fairly healthy PE ratio right now compared to the other miners? Is that the analysis you're going to be doing?
No, the analysis for me is still it's the juniors, right? I mean, they still got so much catching up to do. Sure, you've had several that have bifurcated with the market and they're making all-time highs along with the miners and along with the gold price, but there's still plenty of others that have plenty of catch up to do. So I think it's still best to concentrate on these juniors. Right now, like I said, I think we talked about this last week. I still like the developers, especially the ones with optionality that have yet to really start to move higher and catch up. Also, I mean, if you go down to earlier stage companies like PEA stage companies, there's a lot of value there. So, but still, it's still a stock picker's market. So you can't really just throw a dart at these juniors like you could when I first got into this sector in 2003, 2004 and make money. You can't do that anymore. You have to be a good stock picker.
Well, Dave, when you look at the developers, one of the things that's just blowing my mind lately is how crazy these economics are getting on development stage projects
Mhm.
using spot pricing. And most slide decks have a sensitivity table, but it only goes up to $3,000. Some of them only go up to $2,600. We're at $3,400. When are people going to start running these numbers at where spot prices are? And should people be gradually moving up their trailing, long-term gold price in these things? Because some of these are still factored at such lower gold prices. I think they're shooting themselves in the foot by not capitalizing on the here and the now.
Right. Well, they paid all this money for these reports, and by the time they were issued, the gold price had gone up another two, three, $400. So you have to do it on your own, and that's where the opportunity lies still, right? And you have to sharpen your pencil and get your magnifying glass out and make sure you get into these companies that have that upside and they have all these ounces in the ground. And you take a look at where they are in permitting and how long it's going to be before they can get that mine into production. There's so many factors you have to look at, but I mean that's where the opportunity lies in these juniors. Absolutely, after what you just said, and because these net asset values of some of these projects are astronomical now, and yet the market caps are still 100, $200 million, and yet the net asset value of the project they're de-risking at spot prices is well over $1 billion.
See, Dave, with these developers, though, I find one of the most important aspects right now is time frame for them to be producing because everyone's asset looks like it makes huge money at these prices, but that's at these prices here and now. Yes, the prices might keep moving higher, but I feel like the most important aspect is when will these guys be in production? When could they start actually producing some revenue, some cash flow to take advantage of these higher prices and then be able to put it back into the project. So how much weight are you simply putting on them and what do you think is a reasonable time frame in terms of when they will be producing?
Well, yeah, it depends on the project and the company where they're what jurisdiction it's in. You take dilution is the big one, right? I mean, it's a constant race against, dilution and getting the project de-risked into a construction decision and getting it financed. So that you need to keep that dilution down. Look at the history of when they raised money, how they raised money. Did they have to attach a warrant? Who came into to the placements? I mean, have they got access to capital? That's a big one. These if you look at a company that's got a fantastic project and yet they've yet to attract a financial partner, there must be something wrong with the project or there must be something wrong with management. So you got to make sure of all these things before you get into them.
Dave, I've had a couple people email in a question about how the tariffs are affecting M&A. So when you look at these development projects and we keep asking why are these things not getting bought right now and considering how good they look on paper, why are the companies that have the capacity to put the capital forward and the manpower forward to build these mines, why is it not happening at a faster clip? Are the tariffs weighing on that? How do the tariffs play into M&A?
Well, as far as gold is concerned, there's no tariffs on gold. There's silver. There's no tariffs on metals. But I mean, as far as constructing the mine, there's going to be tariffs on the materials to construct the mine. So absolutely, that's something that is a factor.
Yeah, I think the other thing we need to simply consider too is that these companies are generating cash flow, but it costs a lot to build these mines, and these guys do want that buffer. I don't think they want to necessarily go back to the market and build up debt. So, hey, maybe ride out this market, build up some more cash flow so that they do have plenty of money to get in there and build these assets when they do take them over. We have seen a lot of M&A, but we still haven't seen a whole lot of projects being fast-tracked into production. We'll see when that happens. But as of right now, look, these companies are making money. They're paying down debt. And if they don't have debt, they're building up cash, which they can then use to build these things because mines are still very capital intensive. Dave, we'll wrap it up here. Look, pretty much across the board, it's been time after time that we've been chatting with you where this gold market continues to be a standout and the companies have been joining in. And now we're seeing still that trickle of money down into some of the earlier stage or smaller companies. Still not down into the smallest juniors, but that's okay. There's plenty of these mid tiers and developers and PEA stage companies for investors to continue to pick off. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Dave, great chatting with you today.
Thanks, guys. Always a pleasure.